In today's topic, we will be covering Lesson 5.3 Corporations, found in our business law textbook. The goals are to discuss the nature of corporations, including their advantages and disadvantages, explain how corporations are created, owned, managed, and terminated, and list and describe different types of corporations, including alternatives to the full corporate form. A corporation is defined as a legal entity, or artificial person created through the authority of federal or state law. It can be owned by one or more persons, other corporations, a government body, or a combination of all of these. It can sue, or be sued without its investors being exposed to the risk of losing personal assets to pay any corporate debts that result. It continues in existence beyond the withdrawal or death of its owners due to the free transferability of ownership in the form of certificates of ownership called shares of stock. The advantages of corporations include perpetual life, limited liability, transferability of ownership interests, and the ability to attract large sums of capital and professional management. Perpetual life. Unlike the sole proprietorship, a corporation is a legal entity separate and distinct from its owners and managers. Therefore, it can continue to function after they die. Under the law, a corporation may continue indefinitely with new owners, managers, and employees. Limited liability. The corporation itself is liable without limit for its debts, but its creditors normally cannot collect claims against the corporation from people who own shares in it. Individual stockholders stand to lose only the amount they have already invested in the business. Large sums of capital. Investors feel reasonably secure when buying stock in corporations. Their liability as owners is limited to the amount they have invested, and they may readily sell their shares or buy more. Further, the corporation may have perpetual life, outlasting present owners, directors, and employees, all of whom may be replaced without terminating the business. As a result, large sums of money may be raised by the sale of corporate stock. Small and large investments by thousands of persons and institutions are combined to fund giant corporation. Transferability of ownership interests. A major advantage of the corporate form over the partnership form is the ease of transferring ownership interests in the firm. Professional management. Because they can and do raise substantial amounts of capital, efficient corporations generally have greater financial strength than do other forms of business organization. This enables corporations to attract talented employees by offering generous salaries and fringe benefits. Disadvantages of the corporate form. Double taxation is a tax principle referring to income taxes paid twice on the same source of income. It can occur when income is taxed at both the corporate level and personal level. More costly and more troublesome to organize. Government regulations. Types of corporations include the following 8 examples. 1. Domestic corporation. 2. Foreign corporation. 3. Alien corporation. 4. Public corporation. 5. Private corporation. 6. Profit-making corporation. 7. Nonprofit corporation. 8. Public service corporation. To create a corporation, an application for incorporation must be filed with a state official in the state in which incorporation is sought. This application contains the articles of incorporation, which serve as the corporation's basic plan of operation. The articles are signed and submitted by one or more persons called incorporators. At least one of the incorporators must have legal capacity to enter into a binding contract. Thus, the incorporators cannot all be minors. However, another corporation may be an incorporator. To indicate approval, a state may issue a certificate of incorporation or a charter. Once the corporation receives the corporate charter, units of ownership called shares of stock are sold. The owners, or shareholders, also referred to as stockholders, meet and elect a board of individuals to administer the corporation. This group is called the Board of Directors. The Board of Directors hires the corporate officers and managers who will run the company on a day-to-day basis. These officers and managers use the money received from the initial sale of stock to start doing business. They buy equipment, supplies, and inventory. They hire workers. As goods and services are produced and sold, money flows into the business. If the business is profitable, earnings are either paid out to the shareholders as dividends and/or reinvested in the business. Later, to assist in expansion, more shares of stock may be sold and/or money may be borrowed. The main difference between preferred and common stock is that preferred stock gives no voting rights to shareholders, while common stock does. Common stockholders are last in line, when it comes to company assets, which means they will be paid out after creditors, bondholders, and preferred shareholders.
A corporation is a legal person in the eyes of the law. However, it must act through human agents. No shareholder, not even one that owns most or all the stock, can act for the corporation, or bind it by contract, merely because of such ownership. Regardless, shareholders indirectly control the affairs of a corporation by electing the board of directors. They also have the power to vote on major issues, such as changing the corporate articles, merging with another company, or selling out in a corporate takeover. The directors are responsible for the overall management of the corporation. They are fiduciaries, which makes them duty-bound to act in good faith, and with due care to oversee the corporation, and create its general policies. They must not act fraudulently or illegally. Most states apply the standard of the Model Business Corporation Act. This requires that the directors act in a manner reasonably believed to be in the best interests of the corporation, and with such care as an ordinary prudent person in a like position would use under similar circumstances. Failure to do so can make the director liable for damages to the shareholders. Corporate powers includes making contracts, borrow money and incur other liabilities, lend money and acquire assets, including all forms of real and personal property, make, endorse, and accept commercial paper, or orders or promises to pay money, issue various types of stock and bonds, mortgage, pledge, lease, sell, or assign property, buy back its own stock, unless this would make it impossible for the corporation to pay its debts, or to pay off any superior class of stock. Acquire and hold stock in other corporations provided the result would not violate antitrust laws. Make reasonable donations or gifts for civic or charitable purposes, to promote goodwill in accord with corporate social responsibility. Hire and fire agents, independent contractors, and ordinary employees, establish pension, profit sharing, and other incentive plans for employees, sue and be sued, and utilize other implied powers. Termination of corporations. A variety of causes may bring about the dissolution or termination of a corporation. The cause may be by specification of the incorporators or agreement of the shareholders, by the corporation losing its charter, by consolidation or merger, by bankruptcy, or by court order. Incorporator specification or shareholder agreement. A corporation terminates upon expiration of the agreed-upon period of its existence as stipulated in its articles of incorporation. A corporation may also end before the agreed-upon time, if the shareholders voluntarily vote to end it. Loss of charter. A corporation that has been guilty of certain acts may face state-initiated court proceedings, resulting in the loss of its charter. Examples of such acts are 1. Fraudulent submission of articles of incorporation. 2. Flagrant misuse of corporate powers. 3. Repeated violation of the law. Loss of a charter is rare because the state does not monitor corporate affairs, and persons who have a grievance can seek private relief in court. In addition, termination of corporations can come in the form of loss of charter, consolidation or merger, bankruptcy, or by court order. Alternatives to the full corporate form include S corporations, limited liability corporations, LLC, and limited liability partnerships, LLP. A small corporation that elects to be treated as an S corporation can avoid double taxation of earnings. S corporations are organized under Subchapter S of the Internal Revenue Code. The earnings are treated the same as a gain, or loss, from a partnership and only taxed at the individual owner's level. The S corporation is not so much a corporate form as it is a tax status. To acquire the status, a business must first form itself as a corporation in the normal fashion, and then make a qualified filing with the IRS. In order to qualify as an S corporation under the IRS code, the business must satisfy several requirements. Timely filing. A corporation wanting to be taxed as an S corporation must file the appropriate form with the IRS before March 15 of the tax year in which the election is to be effective. The election must reflect the unanimous choice of the shareholders. Any election to resume being taxed as a C corporation must also be the unanimous decision of shareholders. Domestic corporation. The S corporation status is reserved for businesses incorporated in the United States. Identity of shareholders. Only natural persons, estates, or certain types of trusts can be shareholders in an S corporation. Other corporations, partnerships, non-qualifying trusts, and non-resident aliens cannot. Number of shareholders. The corporation must have 100 or fewer shareholders. What are the requirements for an S corporation? Classes of stock. The corporation can have only one class of stock. However, the shareholders in that class are not required to have the same voting rights. Limited liability corporations. For years, the best forms of business organization for small businesses were the limited partnership and the subchapter S corporation. These forms had flaws and limitations. Consequently, in 1977 legislators in Wyoming took a bold step toward providing business organization alternatives by passing a statute that authorized creation of a limited liability corporation. They based their actions on forms of business organizations that existed in Europe and South America. In essence, the Limited Liability Corporation, LLC, offers limited liability protection and taxation as a partnership, but lacks the limitations of the subchapter S or limited partnership alternatives. For more than a decade, the LLC itself remained an alternative only in Wyoming and Florida. Interest in LLCs grew in 1988, when the Internal Revenue Service ruled that LLCs would be taxed as partnerships at the federal level. By late 1997, every state had an LLC empowering statute. Formation of a limited liability corporation, LLC. Similar to a corporation or limited partnership, a limited liability corporation must be formed and operated in accordance with the law in the state in which it is organized. In most states, an LLC is formed by filing articles of organization in an appropriate state office, usually the Secretary of State's office. The owners of an LLC are known as members. As with C corporations, their liability is limited to the amount that they have invested in the business. The earnings of the LLC, however, are taxed as a partnership. This eliminates the double taxation that occurs with the C corporation. However, some states allow certain members to declare themselves as fully personally liable at the time of organization. This is often a plus with potential creditors. The significant advantages that make LLCs more attractive than other forms of organization are as follows. 1. There are no limitations on the number of members. 2. There are no limitations as to whom or what can be a stockholder in an LLC. Therefore, foreign nationals, corporations, and other business entities can all be shareholders. 3. Members are allowed to participate completely in managing the business. There are no worries of losing the limited liability status for members who do manage, as might be the case even under ROLPA. Tax problems associated with transferring assets from a partnership or corporation to the LLC are the only significant disadvantage of LLCs.